This is Al Brooks, and this is my price action trading course. Here are some recent charts of major markets as of the end of September in 2012. This is a monthly chart of crude oil, and it had a parabolic wedge and higher high. Big up, big down. So here's the parabolic wedge, first push here, 2, 3. You can call it a higher high major trend reversal, even though it's very stretched out. It was followed by a huge bear break, a huge bear spike. Whenever the market has big up and big down, the result is big confusion. Big confusion means trading range, and that's what the market has been in for the past several years. It's been in a trading range on the monthly chart. On the daily chart, however, there can be bull and bear trends. And here we had a two-legged push-up late in a bear trend, so a possible final flag. And then here we had a small 2 pushes up, a smaller final flag. You can argue the whole pattern is 3 small pushes down, 1, 2, 3. You could even argue that this is a lower low major trend reversal if you draw the trend line here. I would not. I think this is the bear trend. This contains the channel better. Again, crude oil daily chart. So for me, although I think you probably could buy here expecting the market at a minimum to come back up into the final flag, if you want a higher probability trade, you can wait until you see this big bull spike and then another big bull bar and sideways into a triangle. Why is it a triangle? 3 pushes down, 1, 2, and 3. So you can draw a rough triangle. If you don't want to call it a triangle, you can call it a high 2 pushes down, 1, 2, a pullback to the moving average. It doesn't matter what you call it, it's a higher low major trend reversal. We had a bear trend, clearly a strong breakout above the bear trend and above the moving average, and now we pulled back to the moving average and we tried to break through it twice strongly. Strong bear bar, bounce, strong bear bar, and hammering at the bottom of the moving average. We were unable to do it. I think the market went always in long on this bull bar, or maybe certainly by the end of this bull bar, and traders are looking for more up. And whenever the market's always in long, you can buy for any reason. You can just buy at the market, and your stop is below the bottom of the spike, probably down here, maybe below the bottom of this bull bar. So you're trading a certain position size, and you have to, you're trading a certain risk, bigger stop than what you might customarily want. And when you do that, you have to use a smaller position size. If you used a tighter stop, like maybe below this bull bar or maybe below this pullback, you could trade a larger position size. In any case, I would be looking to buy above the high of a bull bar. You could buy above this bar, you would have been filled over here. You could buy above this bar, you would have been filled at the same price. Or you could have said this is the breakout even though it's small, and then this little tail down and up is the pullback. So the market broke out, pulled back, and now it's setting up a breakout pullback buy. In any case, the entry would have been all around the same price. Very strong move up, still always in long, might enter a trading range, and we pulled back sharply and formed a double bottom. I would not have bought here, even though outside up, because that strong bear bar, and you can argue this is a spike and channel, and it could have 2 pushes down, so I would wait. And here's the second push down. Entry on this, I think, is tricky. With the double bottom and the higher low major trend reversal and another, you could also argue this is a higher low major trend reversal as well. The market might be paying more attention to this than to this. Nobody knows. I think it's okay to buy above this bull bar, which is the high of that bear bar, for a swing trade up, and the market did trade up. 3 pushes up on this last leg. You could draw a rough channel in here. Not necessarily using the exact highs, but the ballpark. You can see the market looks like it's something in a channel. And channels are rarely exact, and I don't worry about them being exact as long as you realize what's going on. To me, that's a pretty good channel. And now we have a strong bear breakout, possible 1 bar final flag, and we're starting to test down to the beginning of the channel after the spike. So here's the spike, channel begun here, maybe again here, and the market's testing down to this area. I think we're probably going to go more sideways in here. I would not be buying bear signal bar. Channel down is too tight. Usually after any kind of a wedge top, I know this is not a great looking wedge, 1, 2, 3, but functionally it might be the same. You usually get a second leg down. You can say, well, it had 2 legs down, here, pull back here, but the move down is in such a tight channel, it probably is only the first of two larger legs, even though the first subdivided. What also took place here is testing the bottom of a trading range. So a lot of times you'll get bulls who will buy all through here, expecting the market to continue higher, and they don't care that it breaks out. They let it break out, and they ride their longs all the way down because they expect the market to come back and test their entry. They don't know. It may have just stopped here and turned up, and they did not want to exit their longs. These are hardcore bulls who are swinging for long periods of time. So they'll allow these pullbacks expecting the market to turn up. But when it did not, and it kept going down, they thought that, well, that's strong enough, maybe it'll have a second leg down. So what they then do is they wait for a rally to try to get to exit, but with a smaller loss. So these strong bulls are not going to exit down here. They're going to say, okay, we're probably having a bigger major trend reversal, and we'll probably get a second leg down. So if we get a bounce up to near the breakout point, then I'll sell out of my longs. So when the market gets up there, you start to get selling pressure. These bulls start to sell out of their longs, and it looks like they capitulated over here. And if you're one of these bulls who rode through this terrible sell-off and then rode through this rally, are you going to buy one or two ticks later, one or two bars later, $1 or $2 down? No, you're going to wait for a big correction to make sure that the correction is over before you look to buy again. And that's why the market probably will have a second leg down, because the bulls will not be eager to buy. If they held through all of this and through all of this, and they finally get out over here, they're not going to be quick to jump in. Why would they buy here if they just exited here? Okay, they're going to give the market time to make sure we're not turning into a bear trend. And they're also confident that the market won't go straight up. If it does, they'll buy it back up here. They think it's more likely we'll have a second leg down. Once that second leg down forms, then they might start to look to buy again. Here's the monthly chart of gold. This was a very popular chart last year. People were on television talking about gold going up to 5,000, and they might be right, but they make it sound like it's going to happen this year, and it's not going to happen this year. Clearly a bull channel. There are many ways to draw the channel. I could have drawn across these lows. Okay, I drew it here because this is the new channel. We're starting to resume up, so this is probably the bottom of a new channel, and that's why I put the channel line at this low instead of keeping it below these lows. In any case, we had a channel up here. We broke to the upside and reversed down, and we did so at resistance. Look at the high of this bar and the low of that bar. It creates this gap. This gray box is the gap. Whenever there's a gap, you have to be looking for a possible measured move, and you start at the bottom of the bull spike. So the bottom of the bull spike to the middle of the gap projects up to right here, right below the final highs. So we have a parabolic climax. The market is accelerating upward, and a large 2-bar reversal, small double top bear flag. Right? To me, this means we will get at least 10 bars 2 legs sideways to down. On a monthly chart, that's a year. 10 bars is almost 12 bars a year. So we got 1 or 2 bars down. We actually got 3. We got a triangle. 1 push down here, second push down here, third push down here. So we have a triangle, and then the market had a couple inside bars, both bull bodies. So to me, that's a reasonable buy setup, and the market then has rallied since. We'll probably double top in this area and resume the trading range, but it is possible that the trend will resume. I just think it's more likely that we're going to go more sideways. Here's gold again, this time on the daily chart, and this is part of that correction, the most recent leg down in that correction. And look what happened. We had a very strong sell-off, and then we started getting these big bull bars, big bull bars. So tremendous buying pressure, tremendous urgency on the part of bulls. We broke above the trend line with a very big bar, and we kind of held above that trend line for about 10 or 15 bars and above the moving average. So bulls will look for a major trend reversal to buy. They might buy here, arguing maybe a small final flag and a higher low major trend reversal. Another strong bull spike, so they'll look to buy pullbacks. Okay, 3 pushes down, so a wedge bull flag, 1, 2, and 3. And then we have another breakout, and then another small double bottom, and then a clearer breakout of this triangle. and a pullback, I think you could buy here, and you could also buy here. Okay, so we have a triangle, a bull breakout. We just had a higher low major trend reversal, and this is another higher low. Maybe we'll start to break out and get higher highs. I think you can buy here. I think this is a higher probability buy on the close of this bar. In fact, that's where I went long. It looks like we broke out above the double top, and it looks like we're trying to break out of the entire trading range. And if so, we could get a measured move up based on the height of the triangle. And that's what we've been in the process of accomplishing. I don't have the measured move in, but just looking at it, it looks like the measured move is somewhere just below where we are now. Tight trading range, possible final flag, but still clearly always in long. Bond futures, I think, are fascinating. This is, I think, the possible high of our lifetimes. I don't know that the final top is in. You can argue wedge, 1 push up, 2, 3, or you could call this the first push up, 1, 2, 3. It doesn't matter. We're starting to get pushes up and convergent lines. Very often when you have a very strong second push up, the count gets reset and this becomes the first. So nobody knows whether this is the start of a new wedge and this is the second push and we'll have one more high and then the reversal, or whether the high is already in from either this and this or that for bar number 1 and then 2 and 3. This very strong bull leg might be resulting in a measured move. So you take from the bottom of the leg to the top of it and project up, and we're right around there. So we're right at a resistance level. We're at the resistance level of the top of this trend channel line, but we may need one more push up. Either way, the pattern is so extreme, and it took place over 4 or 5 years. I think we'll probably trade down to the bottom of the channel, here or here. And if we do, we can enter a trading range that could last for a decade or more. So that may go beyond my trading career. I'm already 60. So if it lasts 20 years, I still might be trading. I enjoy trading. It's my favorite thing to do. But I don't know that I'll be trading 20 years from now. And it may take that long for the market to get back up here, if it ever gets back up here again. Is the market always in long? Yes. We have not had a sell signal yet. Right? We have a signal bar, but it's a bull body, not ideal. And we're still forming higher highs and higher lows, and we're still above the moving average. However, a wedge top can lead to a significant reversal. It just hasn't happened yet. So it's still always in long, but I think if we do go up, there's probably not much left. Apple, the world's most famous stock and the world's richest company, the one with the biggest dollar value. And everyone, this is the monthly chart of Apple, and everyone's aware that we're in a very strong bull trend. We had a channel with this bull line, and we broke violently above it and had good follow through. I don't hear anyone talking about this red line. I drew this in as a parallel from the bottom of the bull trend. I got the trend line below, and I created a parallel and then anchored it to the top of this bull spike. And if you actually, I think I anchored it to this high, either one. Anyway, right now we're breaking above it and we have a big tail. This could end up as a small final flag, and the market will probably, after consecutive buy climaxes and a reversal down from the top of the channel, I think the market probably 60% will start to go into a trading range like we had here. It lasted for over a year. Remember, I'm looking for 10 bars, 2 legs. 10 bars on the monthly chart is about a year. So I think we're probably forming a trading range with maybe the bottom of the range here. And even if this is the bottom of the range, we'll then be left with a very large gap from this high to that low. And gaps usually fill in. So I think Apple has probably seen the high for the next at least 1 year, maybe more. And we'll probably trade at least down to the bottom of this last leg up, and we may fill in some of the gap between this high and that low. Remember, every trend bar is a gap bar, so every trend is a gap. And this is a pretty strong bull breakout, so this is a gap, but it's very big. Gaps are usually small, like between here and here, right? Or between here and here. But here we got a huge gap, and usually huge gaps usually fill in. So we'll probably go sideways in here at some point, between $400 and $500 $400 and $600 for years, and we may be in the process of starting that correction. It has not begun yet, but it looks like, to me, we're likely to get it. S&P cash index. Okay, this is the monthly chart going back to 1994 or so, and you can see 3 big pushes up, a trading range. So we've been in our trading range, at least from here. I would argue that the trading range began here. The last leg of the bull channel, is part of the sideways movement. So even though it's part of a bull trend, it has evolved into a trading range, and I think of this as the first leg in the trading range, not this. I think this is the second leg. You can draw a channel across the lows and create a parallel, and we're far from that channel. Everyone sees that we have 2 pushes up, 1, 2, and then 2 more pushes up, 3, 4. So a low 4 short in a channel very often is a sell signal. On the monthly chart, we're not at clear resistance. We're not at the top of this channel, and we're not up here at the old highs, at that trend channel line above. So the monthly chart, to me, looks like we could go higher. The tail on top, yesterday was the last day of the month. Tail on top, so we might be having a little pullback, but I think the monthly bears need a better sell signal. Here's the Dow Jones Industrial monthly chart, and you can see that the crash in 2008 and 9 reversed up from a bull trend line, and it was drawn across the 87 lows and the 90 lows. At the time, this was a 25% correction in one day, the 1987 crash, so a very important low, and this was a very important low as well. So it generated a trend line, and the market reversed from that trend line back in 09 with a little final flag right here. Okay. However, there's another trend line you can draw using the 87 low and having it be the second point and not the first point of the trend line, and it goes from here. And we have not hit that second line, and to me that's just as convincing and obvious as this line. So I think we're probably going to try to come back and hit this line at some point in the next few years. I know nobody's talking about that on television. Everyone's talking about the breakout to the new high, and you even have some people on television saying that the Dow is going up to 20,000 this year, which would be, I don't know, 50%, 40% rally from here. But I don't think so. If the Dow does get to a new high and starts to turn down, then it will be a large expanding triangle top. A high, higher high, third higher high, a low, lower low. So 1, 2, 3, 4, 5. So if we do get up to a new high and form a reversal, I think it's a fairly reliable short. Right now, I think we're near the top of a 12-year, 13, 14-year trading range. And trading range, buy low, sell high, scalp, we're near the top. So on the monthly chart, I would only be looking to sell. If you want additional information about price action, you can go to my website, brookspriceaction.com, and I have free examples of E-mini charts that are analyzed bar by bar. I do that every day, and there are also many articles and videos and links to my articles. And that is the end of the module on the recent charts up to September 28th, 2012.